these slides are kind of a combination of stuff that I put together over the last few months. And at the heart of it is kind of the whole idea of American exceptionalism and how the events of the last really almost 2 months now have certainly brought that into question about is the past 10 years and the significant outperformance of, by many measures, of the U.S. economy and equity markets versus the rest of the world, is that going to continue? And my argument is that, yeah, it will. In fact, I think that a lot of the um, kind of the movements and the uncertainties are really at the core of it is not so much around the US, it's around Europe and more importantly around China. And this I've talked about, which is per capita GDP in the US, Europe, particularly Germany, which is the black line, and kind of the slowdown in China growth. And um, even that 5% number is certainly suspect in terms of how they create it. So China has slowed down dramatically, and the information is that the U.S. has grown substantially versus the rest of Europe, Germany, and Euro area as well. There are two issues that have certainly brought the question of U.S. exceptionalism under pressure. One is clearly the tariffs, and Trump's tariffs have risen to the levels of the 1930s and what that might do to the economy of the world and the U.S., et cetera. And then the second, which is coming more into focus, is the acceleration of U.S. debt growth from deficits and potentially the extension of the 2017 tax cuts and what that might do to debt. And the red line is important because that tells you the percentage of deficit to GDP in the U.S. This is the CBO projection. And this is kind of using current interest rates, which is they forecast roughly around 4%. And certainly that number would get substantially bigger if interest rates were to rise because so much of the deficit is interest expense. The other component is the come to Jesus moment of Europe's big bang on spending the defense and infrastructure, by and large, led first by Germany and then by the rest of Europe, with the argument that potentially you have as much as call it 1.5 to 2 trillion euros of expenditure and in Europe and including Germany, with the core of it being in defense. And what that means is how you characterize it is that you have a massive government expenditure spending, which will drive economic growth in Europe, and certainly versus the US, where basically the opposite is happening. So the markets, not surprisingly, have moved accordingly, which is European equities have outperformed since the first of the year versus the US. And of course, the dollar has come under enormous pressure versus other major trading partners. So the market is saying that something has changed, and that change could potentially highlight that this is the end of U.S. exceptionalism, whether that's with the currencies or equity or GDP growth. I think that's wrong. I think that the market has just missed the real core of what Germany is doing, what Europe is doing, what China is going to do. And none of it really, at the heart of it, is going to change the trajectory and the exceptionalism of U.S. economic growth. That doesn't mean that U.S. economic growth could be the same as it has been for the last few years. In fact, it could be lower. Having said that, Europe and China will be substantially lower. And the first is that Germany is Japan. So Japan walked down this same path that Germany is walking with today and built up, had little impact on growth, had higher debt loads, obviously, and coined the phrase of bridges to nowhere. Now, whether or not you characterize building tank factories as bridges to nowhere, but clearly building more tanks doesn't necessarily add to GDP growth or productivity, other than maybe you survive as a country. But look at Europe as a whole, which is, if you walk through the path, the more likely scenario of the alternative of Europe is you build 1.5 million man army, do you build a whole lot of tanks and airplanes to combat Russia, or do you hide behind the nuclear shield of France and call it a day, which I think is the more likely scenario. And the other part is part three, which I talk about a lot, which is all of this is undercurrent of China. The goal of the tariffs isn't so much to raise revenue, although to some extent it will. It's more, this is a continuation of the battle against the US and China. And China is under enormous pressure, no matter what the propaganda might say. And I'll go through this pretty quickly. This is just looking at in Europe and the difference of US growth versus European growth and what were the factors that drove it. Labor, productivity, capital investment. If you look at labor productivity, substantially lower in Europe versus the US. It's the same kind of in Germany as well. This is the cumulative real capital growth in Eurozone versus the US. That is, capital has grown in the US. It really hasn't moved all that much in Europe. On the right-hand side, and I'll highlight the middle number, which is European growth, Eurozone growth with and without Ireland. And it's like, what does Ireland have to do with anything? Ireland is a huge exporter to the US, particularly drugs, etc. So without Ireland, take that out, European growth versus US growth looks dramatically, substantially wider than it has been with Ireland. Now we're going to turn to Germany. Germany is the growth engine of Europe. Without German growth, you don't have European growth. And I'll talk about in a moment is that the core of German growth was the bet on China and on exporting to China. On the left-hand side is GDP growth over the last few years actually, in Germany versus historically, which is factor productivity is down, labor supply is down. The only thing keeping it alive is capital growth. And on the right-hand side, it shows that real capital growth is one of the ingredients of German growth. This is a working age population and net capital formation on the left-hand side. What people tend to miss is that you're building capital based on how many people you got and the age of the people. That is, you build a significant amount of capital stock, and as your population shrinks on a relative basis or growth slows, you need less capital. And pretty much most of the investment you make in capital, this gross capital growth, is going to offset depreciation. And it's really that this is not just the US, it's not Germany, it's not Europe, it's China as well. Is that in Japan is a case in point, is that your per capita is really the key to looking at GDP. This is the labor supply. People don't work in Europe. That's the point. If you look at everything else, is that on average, they work roughly about 70% of the hours in the US. You work more hours, you have more GDP. You also have population growth. That is one of the benefits of opening the borders in the last 3 years in the US is that you've added roughly 12 million people to the population of the US of them. And they're not all leaving the country. A very small percentage will actually leave, and that ultimately would generate growth. On the right-hand side is the projected change in the age of the population. Germany is very, very old and getting older, very similar to Japan. And as you age, the demand for different things alters the demand for capital. And you're more from the standpoint, I've got savings, so I got to find someplace to deal with the savings. So this is, I think, just a fascinating chart. On the left-hand side shows you gross savings in Germany, as well as the gross domestic investment. And there's certainly a significant amount of money that's left Germany. And a good chunk went to Eastern Europe to build factories, but a good chunk of it has come to the US. That is, Germany is a net saver. So they have a lot of excess savings, and that excess savings goes someplace, and you kind of go to places where you have the highest return on capital, and that tends to be the US. Sorry about the slide. This is going to the heart of, will Germany and Europe build an army that contains both people, tanks, planes, enough to offset the growth of or the threat of Russia. On the left-hand side is just main battle tank production and versus historically. In the first part of the Cold War in the 1990s, Germany had 4,000 tanks. By 2004, they had less than 2,000 tanks. Now they have roughly about 250 main battle tanks. They have the capacity, in fact, all of Europe has the capacity to build roughly 50 tanks a year. 50 tanks. Now, in contrast, you look at Europe and Russia. Russia can produce 1,500 tanks, and they have an arsenal of about 4,500 tanks. Now, a good chunk of those tanks are in Ukraine. So, from the standpoint of does Germany, more importantly, Europe in general, have the capacity to build enough tanks? You're going to build a whole lot of tank farms, of course, but you're certainly not going to come close anytime soon to building the 1,500 tanks per year that Russia can build. On the right-hand side is the economics of building jet planes. The U.S. builds roughly 250 jet planes a year, fighter planes, which is roughly about the same number as China. Russia can produce about in the neighborhood of 150 planes. Right now, the Eurofighter, which is the production of fighter jets by Airbus, is roughly about 20 per year. Per year. The inventory is roughly about 200 planes. So even if Germany says, I want to buy a whole lot more planes, or Italy wants to buy a whole more planes, you got to add it to that inventory because you have to build a whole lot more production facilities to build planes. But in contrast, which are the two boxes on the right-hand side, Airbus builds the Eurofighter. They also build Airbus passenger planes. They sold roughly about 800 of them last year. The inventory, the orders and demand is roughly almost 9,000. And certainly with China deciding it doesn't want to buy U.S. planes, that number will get any bigger. So put yourself in Airbus's position. Would you rather build a 330 or would you rather build a Eurojet? And the answer is more Airbus, more passenger planes. So the likelihood of Airbus coming and deciding that I'm going to build more fighters, and certainly they don't have the capacity anytime soon to build the fighters. You can go through each one of the increments of growth of an army in Europe or in Germany, and you come up with the same analysis. What I don't talk about is the German army right now is roughly about 60,000 men. Now, compared to roughly 1.5 million men for Russia. And the ability to build that 60,000 into any kind of fighting force is going to be competing with Russia anytime soon is pretty unlikely. Coming back to the story around Germany, coming back to the story about Europe, is the bet that Germany made on China and on trade. On the left-hand side, you see the current account balance of Germany and kind of the exposure, one measure of exposure of trade to their economy. Exports but imports is almost 100% of their economy. As growth of trade happened prior to the great financial crisis, huge amounts of money were made in Germany by selling to, most importantly, to China. On the right-hand side is real exports and real GDP. Where exports go in Germany, real exports go, as does real GDP growth. So if you don't have export growth, you're certainly not going to have GDP growth in Germany. And that's not going to happen because the major source of exports for Germany has been to China, and China's imports have actually slowed as their economy has slowed. You look on the right-hand side is the German exports to China and German imports from China. And that's kind of at the core of it. That is, China has really slowed down the purchases of stuff from Germany, but China has actually surged in terms of exports to Germany, and that's going to get even worse. So why is that important? If you look at historically, Chinese growth, particularly driven by China credit impulse after the great financial crisis, has led to German growth. As Germans export growth, as it kind of translates into real GDP in Germany, as well as it ultimately leads to growth in the rest of Europe. So I'm going to turn now to to China and what that might mean for Germany and for Europe. If you look at the kind of the process of growth in China, it was really a function of trade. Trade drove growth. After the great financial crisis, trade kind of flatlined in the world and for China. So China had to figure out a different way to grow. So what did they do? Well, they decided to build stuff, particularly residential and commercial real estate. If you look at the amount of money in the economy that they spend on real estate, it dwarfs, or at least significantly dwarfs, that of the US and Ireland prior to the great financial crisis. And obviously, to anybody that's looked at China on the right-hand side, that market has collapsed. So the issue that China is faced with is how do you replace that? How do you replace property development as an engine of growth? You look at the absolute numbers are staggering. People don't or stop buying. And the important part of the analysis is that they're not buying stuff because they don't want to find a place to live, but rather they look at the real estate market in China as an asset class. That is, they'd rather buy housing than they would buy a Chinese stock. So on the right-hand side is the composition of the housing statistics that you have right now, which is the value of housing, which is huge. The inventory, which is about a quarter of that. That is, there's a lot of overhang inventory. If you look at where sales and actual the level of stimulus thus far, which is roughly about 4 trillion 4 trillion RMB. It's a drop in the bucket. So the level that needs to happen in terms of stimulus in China to offset that inventory of housing. And you've already seen the impact, obviously, in property developers that are falling like leaves. So all this comes down to if housing prices go down, what does that do to the Chinese economy? It's going to do the same thing that it did in the great financial crisis in the US and Europe. Housing prices go down, housing wealth goes down. Housing wealth goes down for households, that means they consume less. If you look at the size of wealth in China in households, it's substantial in terms of housing. And the exposure to banks to housing, the exposure to the economy and housing is substantial. The laws of economics are holding in China as well, even though the data is relatively suspect. As housing prices go down, people consume less because they have less housing and are uncertain about their wealth. On the right-hand side, you see it in terms of savings rates have gone up in China, surprisingly. No, because they need more savings in order to offset the wealth decline of their housing markets. And consumer confidence has fallen like a rock. You also have this demographic issue, which is China's approaching the demographics of Japan. And we all know what happened to Japan. It's happened in Germany, by the way, as well, which is it's the aging of the population. You create problems. You create problems that you need to have money. You change the dynamics of the economy. And that's where China is headed, driven by the one-child policy, by the way. And the art of the pushback is that, well, if you look at China savings rates and investment, very high savings rate, why don't they consume? If you look at the level of gross capital formation in China, which is on the right-hand side, it dwarfs the rest of the world. So why not? Let's turn China into a consumer-driven economy, and everything. That's the engine of growth in China that replaces property development. I think that's unlikely. This is again looking at per capita measures. Yeah, per capita of capital, GDP to capital on the left-hand side, and you have fixed capital, GDP per capita on the left-hand side, and you have fixed capital versus per capita on the x-axis. What you have now in China is the level of fixed capital per capita, I'll say that very fast, is roughly the level of Korea was in 1994. In order to get to the level of Korea today, you're going to have to substantial investment of capital over the next 20, 30 years. So if I actually turn off or start to consume, then I can't grow capital. If I don't grow capital, I can't create GDP growth. So that's at the heart of why China can't become a consumer-driven economy, because it has to invest in order to grow. It comes to the level of per capita growth. Yes, in China, there's lots of wealthy people in terms of hundreds of millions of people, but you have 1.4 billion people. Not all of them are to the level of the income of Shanghai. So what's happened as they've turned from property to look for other ways to invest. And as you put more and more capital into the system, you create less economic growth from that capital investment. On the right-hand side, it shows you the incremental capital or investment that you need in order to create a GDP growth. That is, the ability to create GDP growth out of capital has diminished substantially in China. That is, you're creating stuff that's not really creating incremental GDP growth. If you go to the next page, what does that mean? It means cars. Cars are falling from the sky in China. That is, and you see it more dramatically in electric vehicles. That is to become the dominant producer of electric vehicles in the world. And now they're taking those electric vehicles and exporting them to Germany. So if you think about it from the standpoint, they have built an infrastructure that's creating very cheap cars. And because of the investment you put into it, you don't need to have returns. All you need returns are you create jobs and you create cars. But the next stage, people talk about cars. The next stage will be robotics. One of the um, one of the Chinese are not oblivious to the issue of the property development and the lack of further support for GDP growth in the future. So what they did is they created something called Built in China 2025. And lo and behold, we're in 2025. And what they wanted to do is go upscale in terms of technology and production, not the least of which is electric vehicles, but also robotics. So they put a substantial amount of money in robotics. On the right-hand side, you see the amount of robots that they can produce and the amount that they consume. So after cars are going to come robots. They're going to export those to the world. To give you an idea, this is right now, given tariffs that are available in Europe. This is one particular car company going to produce a car in China and sell it in China and make about $1,000 in euros. I think I put this in euros. If they took that same car, exported it to Europe, paid the tariffs, paid the shipping costs, the base cost goes up by about 7,000 euros. But they can sell it in Europe right now at roughly in the low 40s. So they make a substantial increase in profit by taking the car and selling it to Europe. Europe's not oblivious to that. It's just starting. That is, the car capacity to produce stuff in China is gigantic. It's enough to produce basically all the cars in the world that are necessary. So you don't need German production, you don't need US production, and you don't need Japan production. And unfortunately, domestic sales in China is flatline. So all of that excess capacity, it's coming to the US and Europe and the rest of the world. However, that's assuming that the Europeans don't increase tariffs, and they will. So even though we talk about the tariffs between U.S. and Europe and U.S. and China, what will be a story and continuing story is that Europe doesn't want the cheap cars. So they're going to increase the tariffs. This is just cars. They're going to do the same thing for robotics. And more importantly, this is a existential issue for China. If you look at China growth and you compare it to where exports came from and the entering into the beginning of WTO, which is a preliminary position, they started exporting substantially in the world. And now tariffs are back to, because tariffs came down because they were entered into the WTO. Those tariffs are now back to where they were prior to the export surge. Now, what that's done to some extent is created a global value chain, clearly. And on the right-hand side, you see the impact of it, which is in the U.S., the percentage of national income that's gone to labor has gone down, and the percentage of national income going to corporations have gone up. And to a certain extent, that reflects the ability to produce stuff cheaply overseas or the knowledge economy that's added incremental growth in the U.S. versus labor. This is, I think, what will happen going forward, which is as you start to put barriers to trade, you end up on the left-hand side, which is this is China goods exported by region. Uh, Only to the U.S. is roughly like 550 billion. You add on the amount to Japan, you add on the amount to Europe. So basically, if Europe and Japan and really the developed world follows the lead of the US and starts putting up barriers to trade from China, and they will because they don't want the cheap goods. So think about it from the standpoint of that 550 billion of exports to the US. China can't do that anymore. So where are they going to go? Are they going to go to Japan? They're going to in Korea. They're going to try. But the real source of where they're going to start selling stuff is not the emerging markets. It's going to be Europe. And Europe's going to put as much barriers, tariffs on Chinese goods as we do. And on the right-hand side, you see the alternative of China, which is where are they going to sell consumer goods? Well, the U.S. is the biggest, obviously, and Korea and and Japan add something to it, but it's also Europe and the UK. That is the pressure on China to sell stuff to continue their trade model at almost any price is going to be enormous. But I think that the what you'll see the next round will be Europe and the rest of the developed world putting up the same kind of tariff barriers to Chinese cheap goods as the US is. When I talk about tariffs and I talk about other things that the Trump administration might do, the kind of the benchmark, if you go back to 2016, their promises and what they actually did, just in 2017 to 2020, he basically did everything. In fact, he did everything but one that he proposed. He did everything, whether it be tax cuts, tariffs, et cetera. He did them all. Thus far, he's done pretty much the same thing in his uh, recent endeavors, if you will, recent administration. He's done everything he said he did. That is, he campaigned on promises. He's now kept just about every one of those promises, including tariffs. Now, what he hasn't kept is that tariffs will ultimately bring inflation down. Well, I mean, he'll bring inflation down. He could in terms of putting the economy in a recession, but at least at this stage, tariffs will be actually the opposite. They'll push inflation higher. And if you go to the final page, I hope, I think it's the final page. This is a piece I put out in last year, and I updated it, which is looking at periods of time where S&P has fallen by 15% or more. And those the kind of the light blue boxes are those periods, as well as the black lines are recessions. What you've had in the Trump administration thus far is that tariffs haven't resulted in a recession as of yet, but they certainly had a 15% decline in U.S. equities. So what you see is the brown lines versus the purple lines. The purple lines is equity wealth, and the brown lines are housing wealth. So in a lot of cases, housing wealth increases have offset the impact of lower equity wealth in households. And so the economy didn't go in recession. This time around, housing prices are roughly flat to a little higher. So potentially you could have no recession because the housing market doesn't collapse and the equity market comes back. And I think that's kind of the key, which is for the most part, the people who voted for Trump are not the top 1%. They're not the people that own equity wealth. They're the people that own those brown boxes, which is real housing wealth. So as long as the housing prices continue to increase, if not decline, then I think that the pressure on Trump to reverse his tariffs will be substantially less. So my conclusion is that the underlying guts of U.S. exceptionalism is still there. The big bang of Europe is just not going to happen. It's not going to change the trajectory of economic growth in Europe. And China is going to be under enormous pressure to cave to Trump tariffs. Against this background, I did not add to this the trades that I'm proposing or have on right now, which is one, I'm long Germany sovereign protection, 5-year sovereign protection. I'm long receivers on European rates in the front end. I'm short European equities versus Nasdaq, and finally, I'm short CNH on a forward basis, arguing that the Chinese are going to have to depreciate their currency, and if not, I'm going to roll up to forward currency, which is roughly 7.25. So that's kind of it. Well, I think that the Chinese are smart, right? And it's not as if they didn't know that the U.S. would ultimately, maybe the rest of the world as well, would start to put up barriers to cheap goods. And the least of which is, what did they do? Well, they're sitting around like, okay, I'm not only going to be the battery manufacturer of the world, I'm going to build electric vehicles on the batteries, and I'm going to corner the markets on the ingredients that go into building batteries. Cobalt, for example. So all the cobalt in the world goes to China, and they refine it and put in batteries and sell to the rest of the world. So yeah, they've created choke points that potentially are a way that they can have economic growth, but it's just a minor amount of money. It just doesn't move the needle all that much. But they clearly they create these choke points where they could potentially pressure the U.S. and Europe to not have as high a tariffs as they would otherwise. That is just really a bargaining chip, I think. But if you go back to the original pitch, which is in, I think, in 2020, which is built in China 2025. And one of those things they highlight is electric vehicles and batteries underneath electric vehicles, as well as airplanes. I mean, obviously, they're starting to build their own planes, although not near Airbus or Boeing levels, but they're certainly building their own planes. And robotics is another example, is that they're moving upstream. Um, but as you talked about batteries, it's certainly they are the electric vehicle producer of the world because they have cheap batteries, which is the problem. Because if you're Germany, you're like, I don't know, or Europe, it's like I wanted to sell you my BMWs or Mercedes, but they're not because people would rather buy a very cheap Chinese version, and it's inexpensive, but these are very good cars. But yeah, they certainly have that. The other thing I would say is in terms of robotics, and it comes back to the AI world and chips. China is nowhere close to the sophistication to build the same kind of chips, the high grade chips that the US, Europe can produce, particularly the US. Is that what China is good at in terms of chips is producing them, is not developing them. And developing is where the old intellectual capital, where the incremental value add comes from. So they're a long way from doing anything close to building those kinds of chips. And there's no one close to building the NVIDIA chip, by the way, as well. And China's nowhere close to it as well. But you're right. I mean, I think it's brilliant on their part to have created uh, the epicenter of electric vehicles, arguing that that's where the growth is going to be, and solar panels as well. And but the consequences of them selling those electric vehicles at substantial discounts to Europe is freaking Europe out. So they can build all the electric vehicles in the world, sell them to India and to Brazil, but it's just not we're close to the market of the U.S. and Europe.